Gold and silver, what's driving them today, and what it means for the next decade. Immediate market context and current dynamics. Gold has recently traded above $5,000 per ounce, with silver surging as much as nearly 9% on geopolitical tension and mixed economic data, pushing silver near the mid-80s range. Markets don't move in isolation. This strength is happening alongside policy uncertainty, geopolitical risk, including ongoing talks around tensions in the Middle East, and investors rotating towards safe haven assets. Even as volatility normalizes, gold and silver remain elevated, showing that demand isn't just speculative. Real forces are backing these moves. Why precious metals still matter. Gold and silver aren't just commodities, they are financial insurance. Gold is the traditional refuge when confidence falters. Governments and central banks still accumulate gold as part of reserve diversification, which supports prices. According to analysts, central bank demand is expected to remain in a structural underpinning for gold through 2026. Silver plays a dual role. It's a safe haven and an industrial metal. From solar panels and EVs to advanced electronics and data infrastructure, real economic use keeps demand steady, even when markets dip. That combination is why silver sometimes moves even faster than gold. It's not just money, it's material demand. Historical perspective. Why these metals survived every monetary shift. Gold and silver predate modern currencies. They were money long before fiat existed. Civilizations used them because they were durable, divisible, recognizable, and scarce. For thousands of years, gold was a store of value. Silver was money and an industrial tool. Even after the world left the gold standard in the 1970s, gold kept its role as the ultimate hedge, a safety net against currency debasement and government balance sheet risk. Today's fiat system can't create value. It only reallocates confidence. When confidence shakes, gold and silver are the fallback. Current structural drivers beyond price. Here are the modern forces shaping precious metals. Central bank buying. Central banks continue to buy gold aggressively, citing diversification and geopolitical risk, even in a world of digital assets and complex financial instruments. Dollar dynamics. Analysts suggest a weakening or unstable dollar could inherently support precious metal prices, as these metals are priced in US dollars and gain appeal when currency confidence wavers. Industrial demand. Silver's role in EVs, solar infrastructure, semiconductors, and clean tech is pulling demand from purely financial speculation into real economic usage. Structural shifts. Countries are strengthening strategic reserves not just for energy or oil, but also for critical minerals, including silver and the metals that power industry. Recent initiatives aim to secure domestic supply chains in the US, which can affect overall supply dynamics. This shows precious metals are increasingly tied to national security, technology, and macro stability, not just investor sentiment. Long-term forecasts and what it means for you. Looking ahead, there's a range of institutional forecasts that hint at different futures. Gold. Some large institutions expect gold to slowly grind higher toward $5,400 by the end of 2026, driven by central bank reserves and investor demand. Other top broker forecasts have even higher projections based on monetary trends and structural diversification. Silver. Forecasts vary more widely, from modest support near current levels to very bullish scenarios if the gold to silver ratio compresses and industrial demand surges. Analysts see silver possibly outperforming gold under the right conditions. Regardless of the exact numbers, the key takeaway is this. If confidence in paper money, debt markets, or geopolitical stability weakens, these metals historically gain value because they represent real purchasing power, not promises. Final takeaways and what you should understand. So, what's actually going on? Gold is a safe haven. When uncertainty rises, investors buy protection. This is why gold still matters today and tomorrow. Silver is a hybrid. It acts as both money and industrial fuel, making it unique among real assets. These metals aren't a short-term bet. They're long-term hedges, supply resilience, and wealth preservation tools. Current data shows structural forces. Central bank accumulation, industrial demand, and macro risk are not fleeting trends. They are long-term structural factors shaping precious metals for years to come. This isn't just about prices. It's about how the world stores value, protects wealth, and balances risk in a shifting global economy. Comment gold, silver, or both. Subscribe for insights that matter today and decades from now.